How's everybody doing? Everybody good? I'll take that as a yes. Um, so yeah, I'm gonna wait another minute or two. I expect attendance to be a little light. I know we changed times here compared to normal, and then also for those of you here in Columbus, I know Bold is going on Tuesdays, so anybody that takes Bold is also not gonna be here. So I'll wait another minute or so, and then we'll just jump right in. Obviously, it's going to be recorded, so I'm assuming there'll be some people that watch it later. So, anybody have any specific topics or anything that they want to talk about or hear about before we get started? No? You guys are a talkative, interactive bunch today. All right, cool. Well, I'm going to go ahead then and share my screen and get started. I would say absolutely, if you have questions during the presentation, don't hesitate to interrupt me and just either type it in the chat or probably better yet, just unmute and ask the question. I know Abby has another call right now, and so she's going to be trying to watch, but not necessarily watching as closely as she normally would. So, can everybody see is it full screen or is it on the presenter mode?
Not full screen.
Full screen? All right, cool. All right, so we'll just go ahead and get started. So hopefully you're here for the February market update. If you're not, you can still stay, but just be a surprise. Um, and we do have some good stuff. So I'm just gonna go ahead and jump right in. Just a little bit quickly, I think most of you seeing the names on here, most of you know who I am. However, for those of you that don't, I've been an agent since 2004, which means I had the distinct pleasure of going through the 2008 housing downturn. I think there are a lot of similarities to what we're going through right now from a just an overall mindset perspective, but obviously functionally the market is very, very different than then. And so definitely like to look at numbers and data, and that's how I got started with this. And then Dana just asked me if I wanted to be on the calendar every month. So here we are. I do have a team, Marsh Home Group. The selfless plug is we are growing. So if anybody is interested in considering a team or interested in leadership roles within a team, I would love to chat with you. I'm also a real estate investor. I have 15 investment properties, hoping to continue adding to that. And then I'm also a coach. I would consider this to be my very part-time job, but I do have a few clients with the I Love Coaching company. So that's what I do. Feel free to follow me on Instagram or Facebook, and let's go ahead and jump in. So what we're gonna hit today is inventory and selling trends nationally. For those of you that come regularly, first of all, thank you. And second of all, you kind of know the drill here. We're gonna talk big picture nationally, and then since I'm here in Columbus, I do kind of Columbus at the end, so that anybody that's jumping on that doesn't really care about the Columbus market can jump off. Um, and then we'll look at interest rates since really that's a huge driver of what's going on. And then I just like to talk about different ways that we can talk to our clients about what's happening in the market, because the reality is that if we can know all the data in the world, but if we can't effectively communicate it to our clients, then it's probably not of too much value unless you're a nerd like me and you just like to listen to it. But the most effective way to handle it is to be able to tell your clients and develop strategies appropriately based on that. So let's jump right in. So we're first, like I said, going to look at national numbers. Active listings are up year over year in January and have continued to trend upwards as we've moved into February. I think overall this is a good thing. As you can see, those numbers there at or the line graphs at the top here, those are all pre-pandemic numbers. So you can see how much lower we still are from pre-pandemic. So when you hear people talking about a housing crash, I think you need two main components. Number one, you need more inventory, but most importantly, you need more inventory than buyers entering the market. And so what we've seen over the last few years or since the pandemic started is that there were more buyers than sellers, and therefore inventory went down. When we see inventory going up, it's usually a pretty clear sign that there are more sellers entering the market than buyers. Now, we haven't been, as you can see, this pink line here is last year. We haven't been too far above that, but we have been above that, which I think is overall a good thing. Maybe. All right, pending listings. Also just a little bit above, sorry guys, I'm trying to admit people in the waiting room as well as do this. Pendings are ever so slightly there above last year. You can see that little dot. Not really statistically significant, but up 2.6%. So that's also a good thing. And that's more of an indication really of what's happened 30 days previous, but also a leading indicator on the sales front as well, meaning what's pending now will turn into sales this month or next. Man, I don't know why this is sorry guys, I'm struggling a little bit. I have it in presenter view and for some reason it's not wanting to go to the next slide. New listings, again, these are national numbers, up 2.8%. What I would say, and as we jump into Columbus later, you'll see this, but definitely the national numbers are a national average, right? So definitely some markets have added much more on the new listing side and some less. But in general, I would say the overall trend is that we are seeing new listings nationally tick up and continue to tick up. I don't know if anybody pays attention to Altos Research, but they do a weekly little 10-minute update on the market, and they bring in weekly data. And we're still continuing to see the new listing numbers jump up in spite of, a little bit of a spike in rates still. Average days on market are down a little bit compared to last year at the same time. Again, 4 days, not super significant statistically speaking, but just an indication that still homes tend to be moving faster than normal when we compare it to those pre-pandemic numbers. Median list price, which Realtor.com does not publish a median or average sales price number consistently anyways. Sometimes they bury it in the verbiage, but not from a graphical perspective. So the median list price is really typically a forward leading indicator on what the sales numbers are going to look like. And you can see that it's up a modest 1.4% over last year. If we look at the way last year trended compared to 2022, looking at kind of year over year, everything before 2022 basically had jumped up pretty significantly, and you can see 2023 was almost exactly the same as 2022 once we got to the end of the year. So we weren't seeing a lot of year over year pricing appreciation, and it looks like at least nationally that's continued into the first month of the year. This is always an interesting indicator, the price reduced share. So basically what we're looking at here are the number of properties that are currently listed that have had a price reduction. And you can see that the number compared to last year is down 1.3%. However, if we look down here, this is 2021 and 2022, you can see that we're about 10%, almost 10% higher than those years. So just to kind of put it into perspective, but overall, we're in what is normally considered to be a pretty average number of price reductions. So that's kind of an interesting stat because it's really the only thing that's in line with pre-pandemic numbers. And so it just kind of tells you that overall seller confidence is pretty normal in the market. So we really look for a kind of changes in those as more of an indication. You can see in 2023 last year, we had interest rates going down in the first half of the year, or really the first quarter. And you can see the number of properties that did a price reduction was dropping pretty quickly. And then per usual, as we move further into the spring, we usually see that number increase as there are more sellers on the market and also as sellers become worried that they've kind of missed the buyer rush of spring. We look at this every month, but I like to look at kind of the median listing price broken out by different region, and you can see the Northeast still continues to be the strongest region nationally. The Midwest has kind of slowed down. It had been kind of Northeast Midwest show for a while there. But we've actually seen the Western United States kind of recover a little bit. Last year, they were down a lot, especially when we looked at year over year numbers. And this year, it seems like they're kind of leveling out. They also, though, when we look at inventory, their active inventory is still down quite a bit, but still less than Northeast and Midwest. You can see the South has definitely been, during the pandemic and really even before that, the South was very, very strong. And they've kind of leveled out in a way that we hadn't seen in a while. But this is the number I like to look at. And I know when we get to my kind of opinion on the market, this is really leads the way for me. Most homeowners have so much equity in their home compared to pre-pandemic that it's just not 2008 again. And the chances of seeing a downturn that's going to impact the average homeowner is just so low with our lending standards and what's happened with pricing appreciation over a relatively short amount of time. This is the conversation I'm having with a lot of people. It's just like, it's not likely that we're going to see people forced to sell like we did in 2008. All right, interest rates. I know everybody's most fun conversation. There's a part of me that wants to just delete this from the presentation because at the end of the day, we have zero control over it. And so at the end of the day, like focusing on it and obsessing over it, like I sometimes do, is just not healthy. But the reality is that it is the driver of the market. And this right here is the most important thing that I'm probably going to have in this whole presentation. That really a lot of what consumer behavior is in real estate and really everything, it's not just real estate, it's driven by emotion. And the average consumer is more impacted by change in the rate than it is the overall rate, meaning that when rates go down, they tend to rush in to grab the deal at the moment. And when rates go up, they tend to stop doing anything. And so, in my opinion, outside of the last like 2 or 3 weeks, you can see the overall range has been between like 6.5 and really not even like between 7 and 6.5, let's call it, on a national average. And that was a really healthy market. What we started to see in December and January, where buyers really started to come out, make solid buyer decisions, and sellers were selling, putting their house on the market. We were seeing more new listings. Now we've started to see things kind of plateau a little bit as rates have gotten up to and over 7%. And so it'll remain to be seen what happens with these rates. None of us can predict anything. I have a couple slides following this that talk about some of the reasons why they're fluctuating. On the same token, though, if we look back into the summer and fall of last year, you can see even with the recent movements, it's been really small compared to what we saw. I mean, last year in April, we were down almost down to an average of 6%. And then again, by the middle of October, we were all the way up to 8%. I don't think the Fed wants to see this, but I don't think they're really confident in what to do that's going to help it come down slowly and safely versus I think they have a bigger concern about inflation roaring back, which is what my next slide is. So the reason why rates went up over the last 2 weeks was two main reasons. One, first was we had a really strong jobs report, meaning more jobs were added than they expected, which means the economy is stronger than they expected, and they is Wall Street, because really this is all traders trading stocks and bonds. And then the other thing is last week we had a really stronger than expected inflation number come out. And so you can see as soon as the inflation number came out, the 10-year Treasury yield spiked. And then again on Friday, it had kind of come back down and given back half of its gains. And then on Friday, a different inflation indicator, which tends to run with this one anyways, came out higher than expected, which was kind of expected at that point. And then they spiked back up again. So long story short, we just need to see inflation get back to that 2% average. And this is what it's looked like over the last 12 months in kind of numbers. So you can see that at the beginning of last year, we were up close to 5% year over year inflation. And then we got all the way down in June to like less than 2%. And then that number last week was supposed to be like down here and it was up here. So we're just looking to get that closer to 2%. All right, so now we're going to talk a little bit about interpreting it. So there's a little bit of news here with regards to rates, but I'm going to add a little bit of how to talk. So again, basically with rates, it's all about two things: employment and inflation. And the reason why those two things are what it's all about is because that's what the Federal Reserve wants to see be in line with their expectations in order to start lowering short-term rates. And once short-term rates start going, it puts downward pressure on long-term rates, and everybody in theory is happy. So these are the two numbers that the markets are looking at when they're deciding whether they're going to buy or sell bonds and treasuries, and that's what impacts our long-term rates. Now, one thing that doesn't fall under the Fed mandate with regards to rates, but something that I think could put pressure on the Fed this year, especially with it being an election year, is higher credit card and auto delinquencies. And so I've got a slide here in a second to go through that, and I actually might skip this one and come back to it. So in Q4 of last year, the delinquencies in all things went up by almost 0.5%. But if we look at credit card delinquencies went up by 2.5% compared to the fourth quarter of 2022. And then auto loans also jumped up a little bit as well. But the reason why these things are important is because, in my opinion, they disproportionately impact the poor in our country. And I think the reality is that politicians are basically willing to become friends with anyone in order to get more votes. And so I think there's a pretty good chance that, not say that it wasn't going to happen anyways, but that definitely this is a topic that I could see a politician or maybe all of them grasping onto as a reason why something needs to change. Because I think that inflation, everyone kind of can agree, anybody that's on a fixed income or is a low income person is more impacted by inflation than somebody that has savings or has a lot of extra income. You know, they can just cut back on fun things that they do versus like not eating a meal because the grocery bill went up. And so I really think that that's going to become something that, even though the Fed wants to see inflation come down before they start lowering rates, I think that they're going to be forced to look at it if these numbers continue to get worse. So that's almost solely an opinion, but I mean, there's some other people saying it too, but I think it's definitely something that I'm going to be keeping an eye on for sure. Next slide. I don't know where my buttons are. Oh, there they are. They were underneath all you guys. All right. So, opinion on the market overall, and I've been saying this forever, but I think if you're in a growing city that has low inventory, we're going to continue to see lower than normal days on market, which in theory or practically means that we're in a seller's market. We are seeing buyer activity level out a little bit, especially on the national level. But I think also locally, as we get into the numbers, we're seeing inventory going up by quite a bit, with definitely on a larger percentage basis than the number of new listings coming into the market, which means that there are fewer buyers than there were before. We're not absorbing those new listings immediately like we were even last year at the beginning of the year. Typically, the Federal Reserve wants to see long-term rates around 5.5% nationally. And I think when we look at builders as kind of a use case for this, that the fact that builders are continuing to sell houses at a higher rate while offering incentives of interest rates between 4.5% and 6%, that kind of tells you that the average home buyer is way more comfortable with that rate range than they are with stuff in the 7% range. Obviously, it's an extra selling point for them, which I think is also part of that. But it just kind of signifies that the average consumer is willing to do that. And I think realistically, the further away from the 3% rates that we get, the less people are going to be waiting for those rates to come back. This is one of my favorite questions, though, and I think anytime you have somebody who's saying that they want to wait to buy, this is the question that you should ask them is, what's the likelihood that over the next 3 to 7 years, which is the average time a person owns a home, that prices will go down in your area? The reality is that it's not very likely. Even if we pulled up a number, a chart of the average sales price from 2008 to 2012, you would see that downturn only lasted about 2.5 years, 3 years maybe. And so the chances, number one, that we're going to see another 2008, in my opinion, are almost zero, because everybody in 2000, more than 25% of the market had adjustable rate mortgages in 2008. That's what led to people being forced to sell when prices went down. I think right now, for the most part, if prices go down, people are just going to hold on to their houses and wait for prices to go up because they can't find something as cheap as the payment that they have. The other thing is I think most markets are going to continue to either stay stable and most likely appreciate. So I do think your shorter time horizons have more risk. I mean, let's be honest, if we would have bought in 2021 or even 2022 in the springtime and needed to sell this year in the fall, probably not amazing for somebody, right? But those are very short time horizons. The longer that you go out, and that's why I like that 3-year period, you're really likely, especially in a market like ours in Columbus, but I think it's true for the most part nationally, if you were to buy right now, that 3 years from now, the home prices are going to be up. They may not be up by 30%, but they're going to be up compared to where they are today. So Ultimately, I think this is a conversation we need to be having more often. The other conversation is just really around those rates and the fact that most likely people are going to be continuing to get rid of those 3% rates over time because life happens, right? How long are people going to wait just because of rates? My opinion is that we're going to continue to see people fall off of those rates. All right, so that's all I've got on the national market. What questions, if anything, from those of you who aren't in Columbus and or don't care about the Columbus market? Anybody have anything? Ash, you look very comfortable. I don't think you knew your camera's on, but it is. All right. Well, I'm gonna jump into Columbus here then. All right, so when we look at Columbus, we can see January over January, we were up 17.4% in inventory, but we were only up 9.5% in new listings, which is definitely something to keep an eye on because, again, that means that we're not getting through the old inventory before we're adding new inventory. So if this was exactly the same as this, that would mean that we were keeping on pace with buyer activity. But the fact that it's higher, that means buyer activity is actually lower this year than it was last year at the same time. We can see pendings are up a little bit, which is good news, but sales are pretty level. So I think some of the pending increase is because we have new builds listed on the MLS that sit in pending for quite some time. And then this is what you can show here. We've got again, we do see that we ate up some of the inventory in January that was left over from December. But then when we look at where we were last year, that in February on this date versus where we are this year, you can see we're actually up 36.8%, which is pretty significant. Now, the caveat I always put on this number is that whenever you look at stuff not like in a specific month, inside of the month, the day of the week of that date can sometimes make a big difference, meaning since that's through Sunday, we didn't mark any contingent, or not any, but fewer were marked contingent that might have been waiting for the end of the weekend for highest and best. So just keep that in mind. But again, we've got new listings up 6.6% versus the inventory being up 36%. So that's something we're definitely keeping an eye on. You can see fewer new construction new listings, which is interesting. I don't know that it's a huge deal because when you look at the numbers, it's only about 20 properties, but you can see the overall inventory up. So overall, from a market perspective, we're just seeing that there's more inventory, which I think in terms of the health of the market is a good thing. So this is looking again at resale only through the year. We're at 9.1% up on new listings and 36.8% up on the inventory. Local days on market. So remember, this is based on sold data. So this is kind of a lagging indicator. So meaning what sold in January was really going into contract in November and December in most cases. But you can see kind of the same thing happened last year, where at the beginning of the year, our average sales price to original list price got down to 96%. And then once interest rates had gone down and spring activity started, then we started going over list price again. This also coincided with lower interest rates. So if we are going to stay in the high sixes or low sevens this spring, it'll be interesting to see what happens with this buyer activity, but definitely something that we're keeping an eye on. When we look at year over year numbers, you can see our average days on market was actually exactly the same from January to January. Months of supply is up to 1.4 months. So again, we've been kind of beating the dead horse at this point. But you can see back in May we were at almost 50% of the current inventory. So it'll be interesting to see how that happens. New construction, like I said, a little bit more volatile in terms of how we track through the MLS because obviously the MLS doesn't have all the new inventory, but you can see we're near inventory highs that we saw in January last year. But again, remember that we had all those really low rates last spring. So again, it'll be interesting to see. I think February and March's numbers will be telling if we see the same dip or if we see maybe a flattening instead of a dip. Average sales price, though, and again, average is always a difficult thing because you could have, especially during the winter months, you could have a few really high sales that really throw off an average when the sample size is slow or is low. But when we look at January over January, the average sales price is 10.9% higher, and the average list price is 6.2% higher. So definitely seeing a pretty significant increase when it comes to averages. But again, you can see this is kind of the impact and probably a result of the slower fall. This could also potentially be due to a lot of new construction closes in December, and anybody that's building from the ground up locked prices in lower than they may have been selling for in the month of December, but still pretty interesting. Actually, no, it wouldn't be due to new construction because this is resale only. I'm sorry. All right, for those of you that were in my office meeting last week, you probably saw this, so forgive me, but I just went and compared showings in the last 30 days. So from mid-January to mid-February, you can see the showings per listing and the different price ranges. This is just up to 1 million versus the showings that happened in December. So what's valid about this is that even though when I go to the next slide and you see that we're down year over year, we are still seeing that seasonal bump in activity after the first of the year, which most of you are probably feeling as well. But this is the interesting one that I kind of wanted to share. So we've got 2024, mid-January to mid-February, and then 2023. And I kind of cut this and put it up here just so you could more easily compare the price ranges. But you can see the average listing is, other than the 400 to 500 price range, the average listing is getting significantly fewer showings than they were last year per listing, which is, again, going in line with all of the other numbers, but kind of, I think, the proof in the pudding for sure that there's just fewer buyers out there this year than there were last year. And that's really what's driving the inventory numbers up. And so it's just something to keep an eye on as we move into the springtime. Rents overall for one bedrooms were down month over month, which isn't abnormal for the winter time. But you can see one bedrooms I feel like are kind of silly. I like to focus on the 2 or 3 bedrooms because there's a lot of volatility in this number for some reason. But yeah, you can see year over year rents have largely been pretty stable throughout the US, which is also putting pressure on the real estate sales market, to be honest, because of the fact that rents, as prices and interest rates go up and it becomes more and more costly to own a home, if you can find a rental, like, I mean, you're not owning a home for $1,340 a month pretty much anywhere in Columbus with the current rates. So something definitely to keep in mind as somebody who's been in the industry for almost 20 years. There's really not been much time, if any other time, where it costs less to rent than buy. but now it seems like we're in that environment. And so it'll be interesting to see how that impacts specifically the first time home buyer market, and how strong the American dream of home ownership is versus the logical, dollars and cents of knowing that you're responsible for repairs and all that other stuff, even and being willing to pay more to own than to rent. So last but certainly not least are some sources. I talk about this every month, but these are kind of the places I go to pull this data most of the time. The other place I go, which I should probably add on here, even though I technically don't have any info on here from it, is Altos Research. And again, if you're not listening on YouTube, or I think they have it in podcast form now, wherever you listen to podcasts. But every Monday he does like a 10 or 15-minute kind of blurb on the market changes over the last week. And I just think it's super valuable in a market where things change pretty quickly. So that's all I've got for today in terms of the slide deck. Does anybody else have anything that they would like to add, or questions? Anything I didn't go over that you guys were hoping to hear about?
Troy, just letting you know, I live in Tulla Flats in downtown Dublin, and they just put my rent up 10% from 1540 to 1690. I questioned them, and this is a Casco complex, and that they said across the board in all the good school districts, they're putting theirs up by 10% for the rent. So rents in the good school districts are still going up. I think you may have even seen, I saw the stats the other day that for New Albany schools, they had, in the last 12 months, house prices went up by 18% in New Albany schools, which is to be expected. But yeah, those are the two things. And then the third thing was, I just put two first home buyers, chatting to them about the government first home owners grant that they're tapping on to induce people to start saving for down payments or for closing costs. They're getting around about 7% on their money, up to $100,000, which is a big incentive for them.
I don't think so. What do you do? I haven't heard about that. Tell me more. Treat me
Okay,
like a client.
Okay, so the Ohio Treasurer is tapping on about 2% onto their investment portfolio. Well, it's just really an account. What they have to do is they can go to Kemba or go to any bank and open an account, and they then say that they want to have it towards their, what they call it is an Ohio Home Buyer Plus Savings Program. And what Kemba will do is you make a minimum deposit of $500 in the account in the first 6 months, and keep it in the account for 90 days. They'll receive a match $500 by Kemba. Now, Kemba say the exclusive interest rate is 6.5%. I'm not sure whether that is before the government has added theirs on or not, but it is government assisted. Now, you must use the balance within 5 years. The maximum contribution that you can make is $100,000. And this can be used anywhere towards a down payment on your home or mortgage closing costs. So there's plenty of tax advantages there as well. Yeah,
That's cool.
it started on the 1st of January.
So is it a tax deduction as well?
Well, I'm actually just on here, and it says plus tax advantages. So it doesn't actually say what it is. Now, you can go to the Ohio Treasurer's office, and you can have a look at the participation statement. You must be 18 years of age. your primary residence must be, you must have a primary residence, which can be rent or has to be in the state of Ohio. So yeah, there's a lot of advantages there. I've put 2 first home buyers onto it, and yeah, they'll both greatly appreciated about it. So if you go, I'm just reading right off now off the Canberra Financial Credit Union page, and it says Ohio Home Buyer Plus Savings Program.
Okay, that's cool. Thanks for sharing. And yeah, that's interesting about the rent. And to your point, I know nationally rents have been fairly flat. But to your point, I do think that Columbus is probably going to see different results compared to other areas in the country, and maybe even the city of Columbus compared to the suburbs, which could be something that you're feeling based on that comment from them, that they were only doing it, in suburban school districts.
Yeah. Yeah.
All right. Well, anybody else?
Hi, Troy.
Hi.
I am a new real estate agent. So I have a client. He's approved for VA loan, and I'm gonna meet with him today again. Can you give me like few informations about that? Because I noticed like on some of the listings, it says conventional only. So that means he cannot buy those homes. And how should I tell him this? Thank you.
Yeah, just really quickly, and I would encourage you to chat with his lender for all the details, but in general with VA financing, the biggest reason why a seller would say conventional only would be due to the condition. So both VA and FHA require the appraisers to look a little bit more at overall condition. I would say that I just had a conventional appraiser come back with 7 things that needed fixed that were all silly and, in my opinion, stupid. So that's not to say you can't get that with a conventional loan, but VA and FHA both require that they have a little bit higher standard. And so if something needs a lot of work, the agent sometimes will say that it only works with conventional. That's on single family. The biggest thing with FHA and VA is that the properties have to be on the FHA or VA list or be able to get a spot approval. I don't think, and somebody else on here, if should definitely chime in. I know FHA allows for spot approvals. I'm not sure if VA has a system for spot approvals. But that would be a reason on a condo why, even if it's in good shape, it might say conventional only. And then the last thing I would say is just be careful assuming that everything you read on the MLS is correct. If the agent isn't sure whether it's FHA or VA eligible, they may have just not clicked it because they don't know, or they're being lazy or whatever. So I would just be careful to not show something specifically because it doesn't say that it can be VA finance just because it doesn't say that on the MLS.
Okay, thank you so much.
Absolutely. Anybody else? No? All right. Well, thank you everybody for coming. If you have questions or if you want a copy of the slide deck, you can email me at troy@marshhomegroup.com and we will get this over to you.
Troy,
Yep.
just one quick question, Troy. I've been tracking the last 5 weeks, and I do it always on a Tuesday morning at 9 a.m. And where per week, and we're still tracking downwards on our numbers. Like this morning, we were at exactly 2,400 actives. What do you feel as though that is hitting the market, and or how, or the reason why? What's your opinion on that?
I don't know if it was just me, but right at the beginning of that, you like went into some kind of robot voice mode, and I didn't hear what numbers you were tracking. I heard everything after that, but what specifically were you tracking?
Okay, so Tuesday morning at 9 a.m., because as you alluded to before, it's not really good to look at numbers on the MLS on a Sunday, Monday, because so much is happening. But I feel as though by Tuesday, things have flattened out from the weekend, and you know what's in contract, and people have actually even turned it over to pending or contingent. So I track the active on every Tuesday morning. And this morning we were down again 77 from the same time last Tuesday. And that's been actually over the last 5-6 weeks, that's been pretty consistent. We've been losing 70 to 100 per week. Do you feel as though that's maybe because buyers in the last few weeks have been coming out and we aren't getting that many listings coming on board seasonally?
Yeah, I do. Well, I definitely think that we're still one of the reasons why the year over year numbers are up is because we increased more in the fall this year than we did last year. And even though we're trending down like that at 77, it's going to take a few weeks of that in order to really make it up. It's interesting though, and it's interesting, and the reason is because the overall numbers aren't showing that trend, but I can't say I've tracked in that way. So maybe we are seeing maybe we are seeing more buyers. I mean, my conclusion on that number would be that we are seeing more buyers coming into the market than new listings. I mean, that's, on a very just basic level, that's what we're seeing. And even though it's a relatively small number compared to the overall listings, right? 70 out of 2,500, it's going to take a long time. It's going to take 6 or 7 months in order for that to be really significant, but definitely something that to keep an eye on. It seems like more and more people are calling about listing. But and obviously the overall inventory numbers, show that, but we might be still slightly, I mean, it sounds like we are, not we might be, we are slightly going back into a stronger seller's market as we move further into spring. The only other caveat I will put on that is that typically March is kind of the low water mark for listings, because I always say that as soon as the weather turns, buyers start looking, and a lot of sellers start thinking about selling when the weather turns. But most sellers aren't ready to put their house on the market next week. So then they call their agent and they meet with them, and then the agent gives them a laundry list of things to do, and then their house comes on the market kind of end of April into May and some in June. And so when we look at inventory, that's typically the trend line that we see. And then after June, the buyers all go on vacation because the ones that haven't found a house that have kids in school can't, move in before school starts. And then that whole thing starts all over again. So I would anticipate that our low water mark would be coming up. But it's interesting that the overall numbers are still seem to be trending up year over year, and yet you're seeing them come down week by week. So,
Yeah.
Roy, I in my chat, that's what I was getting at. What Ash just said. It just seems like the inventory is down when you're looking, or they're going quicker. What's available is going quicker because there's maybe less available. But yeah, if your numbers, I mean, I had 12 properties I was tracking like Thursday, and as of this morning, only 4 were left. Eight sold in the 3-4 day period. Then that could be, but it was a decent price range, not too specific. But
yeah, I mean, definitely we're
saying.
still seeing a large number, both nationally and locally, of properties going into contract, within the first 7 days of going on the market. And so, but again, we're seeing there are some markets in the US that are back to pre-pandemic inventory levels. Like Austin, Texas is one that's nearing that. I'm trying to remember. There was one other one that I was actually kind of surprised about from the Altos Research webinar last week that he highlighted. But there are definitely some out there. Some of the, and really in many cases, it's the ones that were the hottest during the pandemic that really just kind of oversold and got so unaffordable to the average buyer that they couldn't, it got crazy. So, but yeah, I think here locally, at the end of the day, even the 36% increase that it was showing still only amounted to like 500 homes. And when you take that into perspective, that we sell in an average year somewhere around 30,000 homes in Central Ohio, an extra 500 homes just isn't going to do it.
Price point probably comes into play too.
It does. Price point, location. You have some areas where you have properties that are still sitting on the market, and you have other areas like where everywhere is getting multiple offers. I mean, I know, Ash, you're very familiar with Wedgwood. I mean, I'm assuming that new listing last week went into contract, but I know.
Yeah, Sheffield went into contract day 2.
Yeah, but I know one of our agents showed it, and I think there were like 25 showings or something set up. And that was a $900,000 house. And just to put it into perspective, I had a 280 condo that went into contract this weekend that had fewer showings than that. 280 in Worthington Schools is getting fewer showings than 900. So it's definitely specific to the market. And yeah, and so that's why the local numbers, I mean, I talk about Columbus in general, but it's almost a disservice to the local numbers. And you really, really, really have to do your due diligence at a listing appointment for sure. But also for your buyers, because their expectations and ability to get a property can be, changes. And I mean, we talked to our team about going through, go through and look at, especially if you have a buyer that's been looking for a few months, go through and look at what do a one-line CMA in the MLS and go through and look at what the average days on market was for the fourth quarter last year, and then look at what the average days on market's been so far since January 1. And in most cases, it's not good to be a buyer right now. So if they took the holidays off and they're expecting things to be the way that they were in November, it's just not the same.
Yeah, and it goes back to that old stage from 2 years ago. If you've got a buyer and they go, "Oh, I love this home. Let's think about this." It's the old saying, if you love it, someone else is going to love it. So we better not think too long. And that's exactly what Todd was seeing with what he was talking last weekend.
Yeah, and I think the inverse to that, is that 33% of them are still left. Which in 2021, it was probably more like 11 were in contract.
Yeah.
And so it is still busy. It is busier than it was in 2019, but it's also not 2021. And so I think, again, I think that as somebody who is experienced and who does pay attention to this stuff, I think the opportunity, and for those of you that are all on this call, you fall into that camp too. The people that understand the market and can effectively communicate what's happening on a week by week and month by month basis is at a very distinct advantage. And when you know, get into the commission conversation and all of that stuff, it's like, how do you add value to your client so that they believe that you are worth what you're getting paid? This is the way.
Yeah.
You know, we don't
It,
control the market, but we do interpret it. And if you're not interpreting the market, you're going to be behind the 8 ball for sure.
there's a great article in the Columbus Realtors email that they sent out the other day, and it says about price growth. It says in 2014 the median sale price was 153,000. In 2023 it was 302,000. That's 97.5% growth in 9 years, which year over year is 4.1%. And it's not going to slow down with Intel coming here.
Yeah.
That's the story to tell.
Absolutely. Well, anybody else have anything? We've got about 2 minutes left. I've got time for one more if anybody else has any questions or comments. No? All right. Well, you guys have an amazing week, and I will see you next month.
Yep.